Oh, class, you made it. The very last video lecture of the semester. We are on to chapter 15 and financial statement analysis. And I'm going to make this one nice and short and sweet for you. So let me get my slideshow going here and get it shared with you. Because I am actually not going to run through all the slides that are I'm actually not going to run through all the slides on this, okay? Okay, so financial statement analysis, it's important to remember that it's going to be used by managers, creditors, investors to make decisions, okay? They're going to take your financial statements, your income statement, your balance sheet, your statement of cash flows, retained earnings, and that's great information, but if you don't know how to use it, it's kind of useless. So we're going to look at different ways that managers, investors, they take this and they use it, and they can use it to compare company to company, companies' previous years to what they're currently doing, stuff like that. Okay, so there's many different ways they can do this in order to make this information more useful to them. The first kind of thing we're going to talk about is common size analysis. There's two different headings underneath this, but this common size analysis is where we're going to take our line items on our income statements. We're going to turn them into percent formats. And the reason this is good is it allows you to compare firm to firm in the same industry when they might be different sizes. Okay, so some firm might have an increase in revenue of 2 billion. Okay, while another firm might have an increase of revenue of only $500 million. Which one's doing better? Well, it depends. There's the one that increased 2 billion. Were they doing 40 billion in sales? So they increased 2 billion. It's a nice increase, but it's not all that much of a percent. What if the one that increased $500 million before was only doing 3 billion in sales? Okay, or 1 billion. Okay, and they almost doubled their sales. Okay, so when you do a common size analysis, it allows you to take companies of two different sizes, put them together, makes them more comparable. Okay. First kind is the horizontal analysis. Horizontal, you remember, is side to side going across. So that's what we're going to do. If you think of your financial statements are listed out, you have 17, 2018, 2019. So what we're going to do is we're going to use a base year and we're going to compare it to that base year and see. Okay, sales. 2017 is our base year. So we take 2018 divided by 2017. What number do we get? Is it like 1.42? That means we increased by 142%. Okay, our sales were 142% of what they were that year. Okay, this is also called trend analysis. So you can see our sales, are we increasing our sales by about the same percent every year? Sometimes did they increase more? Did we lose sales at some point in time? How's our cost of goods sold doing? Okay, are we controlling our cost? Stuff like that. So here's how you would do this. Okay, we have our sales here. We're going to say use base one as your base year. Okay, so our sales in year one were 100,000. It's 100%. In year two, it was 120,000, so it's 120%. In year three, 132 divided by your base year, 132%. So your percent, that would be your common size income statement. As you can see here, year one's always going to be 100% because that's your base year. You just take this one, 75 divided by 60, 125%, 81 divided by 60, 135%. Vertical analysis, on the other hand, is up and down. This is where we take all of our items on and we compare it to one specific item in that statement. Okay, most of the time, if you're doing a vertical analysis on your income statement, you're going to compare everything to sales. Okay, what was our cost of goods sold compared to sales? Was it 60%, 50%? Okay, what was our selling expenses compared to our sales? When you're doing it on a balance sheet, you're going to use total assets or total liabilities and equity. Remember, they equal each other. Okay, but everything's just going to be divided by that number. So as you can see, our net sales for year one would be 100 divided by 100,000. Sales in this time is always 100% because we're buying 60,000 divided by 100,000. 60% means our gross margin 40,000 divided is 40%. 20% with operating expenses, 8% with income taxes, 12% of sales with net income. Okay. Again, trend analysis, you can look 12%, 10%, 9.1%. Our income is becoming less amount of our sales every year. Why is that? Okay, well, here cost of goods sold is jumping up percentage wise. Operating expenses really jumped up here. There may be some reasons why. Okay, ratio analysis is our second major technique, and this is just taking information from the income statement, from the balance sheet, and performing a mathematical function that it gives you. It tells you what the ratio is. Okay, ratios are good, but those numbers by themselves, I can't drive this home enough, they mean absolutely nothing. Okay, there's some like the current ratio. You want to have at least a 1 because your current ratio shows how much you can cover your, are you able to pay your short-term obligations? Well, you don't have a 1, it means you can cover them all. But is a 1.1 good? Is a 1.5 good? Is a 2.8 really that good? It just all depends on what your industry average is and what has happened in the past. Okay, so we're getting these ratios. You really got to compare them to something. There are 3 major types of ratios. This is where I'm going to kind of stop the slide presentation, okay? I'm going to run through, hopefully you have your handout handy, okay? All these slides, they're going to give you all the ratios, how to calculate them, and give you examples. I'm not going to run through them all because they're simple math formulas. You can do that on your own time. I just want to talk a minute about kind of the basics of these ratios. So they're broken down into 3 different types, okay? There's the liquidity ratios. If you remember how liquid something is how quickly it can be converted to cash. So we're talking about liquidity ratios. We want to know how quickly this company can get cash if needed to meet its current obligations, okay? If you're looking on your handout, as you notice, I have some of your ratios bolded. In your homework, you're going to do calculations for all your ratios, but you'll have your notes, you'll have your book and all that. Only the ones in bold are the major ones that I think are important enough to need to remember for your test, okay? The current ratio, current assets minus current, or divided by current liabilities, okay? We want to have enough current assets to pay off our current liabilities. The quick ratio is just like that, almost just like that current ratio, only we're looking at our most liquid assets. We're only looking at our cash and cash equivalents, our receivables, and our short-term investments. What are we leaving off? We're leaving off inventory. We're leaving off the prepaid, okay? Supplies. Stuff that we're really not going to get cash for. Well, we're going to get cash for inventory, but maybe not right away. Who knows how long it's going to take to say it. So the quick ratio gives you a little bit more accurate depiction of if you're able to cover those current liabilities. Okay, the second kind of major group we have is our leverage ratios. That's for short and long-term obligations. We're talking about stuff like time interest earned. Then we're looking at our income and seeing how many times can we pay our interest off. Okay, if we're going, that's a very big number for creditors. If we're going to loan money, we want to make sure we're going to get our interest payments. Okay, there's a debt ratio on here, and then there is the debt to equity ratio. Okay, we want to know here, how is the company structured? Is it head debt heavy? So is it finance a lot? Does the company owe a lot of money, or is it owner heavy? Is it equity heavy? Okay, there's no right way to finance a company. Okay, there's some amount of debt. It's good debt. Okay, if you can take out a loan at 3% and you can go out and generate revenues that are getting you a 12% return, it's definitely good debt because you're making a net 9% on that. Okay, but too much debt can drive you in a hole. Not enough debt, maybe you're relying too much on owners and you're missing some opportunities. Okay, so again, these depend on the historical averages and the industrial averages and stuff like this. Finally, the major category, profitability ratios, it has the most. So we can see a lot of these start with return. We're looking at our net income. Well, how much net income are we getting for our assets? How much are we getting return on sales? Yeah, how's our income? We looked at the other one, there's 12% there. Okay, We might want to get more income based off our sales. Return on common stock, how much income are we getting for each share of common stock that's out there? Earnings per share, how much income can be divided between each of the shares of stock that are out there? How much of that income belongs to each share? It's a very important number for shareholders, along with the dividend yield and the payout, because that's where they're actually getting their cash back. So please take the time to go through the slides. You're going to have a homework question where you have to calculate each and every one of these. So you're either going to have to get it from the slides or get it from the textbook. I'm not going to have a handout on this one either, because it's just doing simple math things. And this is really something that's better for an in class, maybe a discussion board, maybe in my classes in the future. I'll put a discussion board up on this about what, how you look at this, but it's good to know that there are tools out there to use for investors and creditors in order to evaluate the ability of a company to be a successful investment or not. All right, it's been a fun having you for this class. I've enjoyed answering your emails, enjoyed making these videos for you. I hope maybe you've learned a little bit. If you go on to become an accountant, God bless you. Best of luck. Even if your career path takes you elsewhere, I wish you the most success. Stop in and say hi sometime. Take care.